All right, dear students, now we are going to discuss receivables, irrecoverable debts, and the allowances. Now we know that receivables is in the case when we are having the credit sales. For example, we are not selling the goods on credit, or we are not providing the services on credit. There's no concept of receivables then. So receivables or trade receivables or trade debtors is the case when we sell the goods or services on credit. So usually the double entry in that case is debit receivables, because receivable is an asset, the current asset, and credit sales. This is the double entry when we sell the goods or the services on credit. And then we recover the receivable. When we recover the receivable, the double entry is debit cash or bank. For example, if we receive in cash, debit cash. If we receive a check, then we debit the bank. And credit receivable, we de-recognize the receivable because we have already recovered it. And now we do not need to receive any amount from the receivable. Or for example, if they are paying any partial amount, even in that case, what we do is debit cash or bank and credit receivables. But the concept is that not all of the receivables are usually recovered. Like for example, when you are selling the goods on credit, there is a possibility that some receivables might not pay. Now, if you are sure regarding some of the receivables that they will not be paying you, for example, in case of the death, like there was a receivables and now he died, she died, for example, or for example, they ran away, or for example, they refused to pay, or for example, they got bankrupt, any of the condition through which or by which now you are sure that you will not be getting any payment from those receivables, then this gives rise to the case of the irrecoverable debts. So irrecoverable debt is the case when you become sure that the receivable is no longer recoverable. Like due to any reason, now you become sure, you are aware that you will not be able to recover the amount they owe towards you. So in that case, what should be the double entry? The double entry would be that we are going to recognize this as a loss within the statement of profit or loss. So basically we debit the irrecoverable debt, and this is actually an expense which we book or loss we book within the profit or loss, and credit goes to the receivable. So basically what you're doing, for example, we can just discuss that thing in the form of the T account. Like for example, you're having a receivable. Let's assume this is a receivable account. Within the receivable account, you will be having an opening balance. Now, you see this, when we make the credit sales, the double entry is debit receivables, credit sales. So if we make the sales to the receivable, or for example, further sales to the receivable, so the receivable account is being debited due to the sales. So the credit sales, we put over here. This is the double entry over here. Yes, this one. So debit receivables, credit sales. When you sell the goods on credit, it gives rise to a receivable. So basically you debit the receivable account and we give the reference of the sales. As we have discussed this thing within the T accounts in the lecture that you give the reference of the opposite entry. And then when you receive the payment from the receivable, you basically credit the receivable account and the reference is being given of the cash of the bank. So the receivable account is being credited and the reference is the cash or the bank through which you receive the payment. And then we have this irrecoverable debt thing. Like if you are sure that you will no longer be able to recover a particular balance or balances, then what you're going to do, you need to de-recognize this balance from the receivable because it is no longer recoverable. So receivable account is being credited and the reference being given is irrecoverable debt. Basically, this is the entry that goes to the profit or loss. And then after deducting all these balances, we have the closing balance, which goes to the statement of the financial position. So this is how we deal with this receivable thing. So debit receivables, credit sales, we just put that thing into the account. When we recover the receivable, so the receivable account is being credited and the reference is being given with the cash to the bank. And then there is this double entry when there is an irrecoverable debt thing. So basically you de-recognize the receivable account and the reference is being given of the irrecoverable debt. So this is how it works. Now, the second thing we are supposed to discuss is the receivables, allowances for receivables. Now, I told you that irrecoverable debt is the case when you are pretty sure that you will no longer be able to recover that a particular amount. But when you're selling the goods and credit, it is possible, there is a possibility that some of the receivables might not pay, but you are not sure which of the receivables are not going to pay, or what amount you are not going to recover exactly. So in that case, what you need to do is you have to make an accounting estimate. So when the business sell the goods or services on credit, there is a possibility that some receivables might not pay, but you are not sure regarding that. There is a possibility. So you're not sure regarding that. There is a doubt. So basically there is a doubt. There is a doubt that some might not pay. So there's a doubt that some might not pay. Now, because you're not sure that those receivables will be recovered or not, so you cannot de-recognize those things from the receivables. But the prudence concept says that assets should not be overstated and liability should not be understated. So if you believe that there's a possibility that some receivables might not pay, then you need to book a loss or an expense within your statement of profit or loss. But there's no need to de-recognize that thing from the receivables because you're not sure. You need to chase those receivables. You still need to have those receivables within your ledgers. So that is why the topic or the standard suggests that what you can do is you can create a separate account for it known as the allowance for receivables. Now, this allowance for receivable was previously known as the provision for doubtful debts, but usually nowadays we call it as allowance for receivables or allowance for irrecoverable debts. Previously, it used to be called as the provision for doubtful debts. So provision is basically used as a word of the chances that there is a possibility that some receivables might not pay. But obviously, when there's a doubt, so you cannot de-recognize the receivables from the ledger. So what you need to do, you need to create a separate account for it, known as the allowance for the receivables, and previously this was known as a provision for doubtful debts. So as a result, an allowance for irrecoverable debts, allowance for receivables, or you call it allowance for irrecoverable debts. So an allowance for irrecoverable debt account is created. So what is the double entry? The double entry is simply debit again, debit irrecoverable debt. This remains the same. Debit irrecoverable debt. And the credit entry is not the receivables. You cannot de-recognize it from the receivables because you still need to chase it. you still need to have those balances shown in your ledger because you're chasing it. So the credit entry is making a separate account, allowance for receivables. Okay, now the question is that, okay, fine, we got the idea that this irrecoverable debt expense goes to the profit or loss. Fine. Now, where this allowance for receivable is going within the financial statement, because everything goes to the financial statement, where this balance is going. So remember one thing, that this balance, closing allowance, remember this thing, always remember this thing, closing allowance is deducted from the receivable balance in the statement of financial position. So closing allowance is deducted from the receivable balance in the statement of the financial position. So you see, I told you that this closing balance goes to the statement of the financial position. So basically you take this balance. So in the current asset, what we do, in the current asset, we have the receivable balance, receivable, and this is coming from the ledger over here. Yes, this one. So you take this balance over here. I can just show you over here. This balance comes from the receivable account. And then we deduct the closing allowance from it. We deduct the closing allowance from it. So this is the net balance that is shown within the statement of the financial position. So remember that the difference between these two, what is the difference between the irrecoverable debt and the allowances? The debit entry remains the same. Can you see it? The debit entry remains the same. Debit irrecoverable. Let me just highlight it. Let me just highlight it for you. So debit irrecoverable debt, and credit goes to the receivable. This is the double entry of the irrecoverable debt, regarding which you are sure that it is not recoverable. Now, when it comes to a doubt that, for example, you are selling the goods and credit and you believe that some receivables might not, but for example, you believe there is an accounting estimate, then 1% of the receivables might not pay, 2% of the receivables might not pay. So according to the prudence concept, you already recognize a loss related to that or expense related to that. So debit entry remains the same. Over here again, you see the debit entry remains the same. The debit entry is debited recoverable debt, both in the cases of the irrecoverable debt and the allowances. But the credit entry is different. You see over here, we have the credit entry goes to the receivable account. We de-recognize it from the receivable account because regarding this, we are pretty sure that this will not be recoverable. But over here, we cannot de-recognize it from the receivable because we are still chasing it. So we need that balance within the ledger. But what we do instead is we create a separate account known as the allowance for the receivables. So where did this allowance for receivable go within the statement of the financial position? So we take the balance, this one, the closing balance from the receivable ledger that goes to the statement of financial position, and then we deduct the closing allowance from it. So you need to remember, because there are going to be questions within your exam related to this topic, that allowance for receivable is not deducted from the receivable ledger. We have a separate account for it known as the allowance for receivable, and that closing allowance is deducted directly from the receivable balance in the statement of the financial position. This is what you need to remember regarding this.